Welcome back, guys. Today let's use Warren Buffett's mentor, Benjamin Graham's stock-picking criteria listed in the famous book, The Intelligent Investor, to look at the China coal mining company Anhui Hengyuan Coal Industry and Electricity Power. The English abbreviation is HYMD. So Benjamin's first criterion is adequate size. Hengyuan's market capital is 9 billion Chinese yuan, ranked number 22 in coal industry. Its annual revenue is 7 billion Chinese yuan, so its size is decent. Number 2 is strong financials. Hengyuan's current ratio is 1.51, not meeting the requirement of greater than 2. Its working capital is larger than its long-term debt. Number 3 is earning stability. So far, Hengyuan only managed to stay profitable for 9 consecutive years. It's not meeting the greater than 10 years requirement. Number 4 is dividend record. Hengyuan has paid out dividends for 8 consecutive years, not meeting the requirement of more than 10 years. Number 5 is earnings growth. In the past 10 years, since Hengyuan experienced huge loss during the beginning 3 years, if you calculate the ratio of end 3-year average earning to the beginning 3-year average earning, you actually get a negative value. So this one is not meeting Benjamin's requirement of greater than 1/3 or 33%. But note that if you only look at the past 8 years, its earnings growth is actually decent. It's 63.2%. Number 6, moderate price to earning. Hengyuan's 3-year average price to earning is 4.7, meeting the requirement of less than 15. And number 7 is moderate price to assets. Hengyuan's price to book ratio is 0.76, meeting the requirement of less than 1.5. So we can see that Hengyuan actually failed multiple criteria. A defensive investor may quickly turn away from this stock, but let's go ahead and calculate its intrinsic value. From the latest 2024 annual report, I calculated Hengyuan's liquidation value is 2.9 billion Chinese yuan. If we assume it can sustain a plus 5% annual growth rate, then the next 10 years dividend sum is 9.5 billion yuan, corresponding to intrinsic value of 10.31 yuan per share. If we assume no growth, then the next 10 years dividend sum is 5.8 billion Chinese yuan, corresponding to intrinsic value of 7.26 yuan per share. If we assume Hengyuan's earning is on a declining trajectory, losing 10% every year, then the next 10-year dividend sum is 2 billion Chinese yuan, corresponding to intrinsic value of 4.12 yuan per share. Even with a lot of optimism, I think Hengyuan's intrinsic value is only around 7.5 yuan per share. I hope you liked this analysis. What do you think about Hengyuan? Let's discuss in the comments. Stay tuned.